What's going on, everybody? It's your host, Corey Reyment, of another episode of the Wisconsin Investor. And today I have another Wisconsin investor here that I'm going to be talking to who is based down in the Madison area. So for those of you guys that have been listening in, we at our company, Wisconsin Discount Properties, we are expanding down into the Madison area. And so myself and a few other folks from our team took a trip down there a couple of weeks ago, and Joe was gracious enough to sit down and meet with us and his partner Kent and talk with us about what they're doing in the industry. But to give you a little background here, Joe, just a little bio on Joe. I have Joe Miller with us today, who is a Wisconsin investor, as I said, and the founder of Rezen, which is a vertically integrated real estate company based in the Madison area. So I'll let him explain what that is here in a second. But basically, Joe got to start as a wholesaler and then quickly grew into operations, spanning wholesale, fix and flip, long-term rentals, property management, private lending. So this dude has done a ton of stuff, guys. This is going to be a fire episode. And he specializes in creative deal structuring. So we were just talking prior to hitting record on some creative stuff that he's aware of that I was like, I didn't even know what the heck this stuff was. It was kind of fun. But Joe, welcome to the podcast, man.
Yeah, thanks for having me, man. Super excited to be here. First time doing a podcast, so it should be a great time. Yeah, and that was an awesome intro. Appreciate that. And it was awesome meeting your team last week, by the way. That was super cool. Good group of guys and girls, yeah. It seems like you guys have there. So excited for you guys to be coming to our market and to start do a little bit more deal activity with you guys actively. So should be good.
Agreed, man. It was great meeting you guys. And again, like I said, appreciate the time. I know you guys have a lot going on. And so to sit down and just talk to a bunch of jokers coming into town that you don't know, for an hour and give us a ton of information and a lot of back and forth. And we had hopefully some good value exchange both ways. It was really, really great to hang with you guys for a little bit.
We learned a lot from you guys. And I really loved how you guys led with value. You're coming in what can we do to connect some dots for you? Connecting us with a property manager for our property management business. So yeah, super excited for you guys to be in our market. We welcome, more players, especially people that do it right like you guys. So
awesome, man.
It's gonna be awesome.
Well, how did you get into real estate, Joe? Take us back. So you started with wholesale, and I always like starting at how people began because it's kind of fun to reminisce about the early days, and you learn a lot of lessons as you grow. But what was the catalyst to get you into the real estate business as a start?
Yeah, so I guess to go even before I was a wholesaler, I was at UW studying business. And so I got to my final year and realized I'd had a good time, but I hadn't really figured out what I was going to do now. And I found Pace Morby YouTube University, went really down that rabbit hole for probably 3 to 6 months, doing as much education there as I was in school. And I decided hey, maybe real estate's going to be that thing that I do when I get done with college. And so that's basically how it started. Hit the ground running, joined my local REIA, met some, local investors. They knew creative real estate. So it happened that first my background that I learned myself was really creative based. And then I just happened to get connected up with probably some of the more creative people in our market. And I had this, really good background there, but I didn't really know wholesale and I didn't really have any money. So I ultimately decided to first lean into creative deal structuring, try to go that route, but found I couldn't scale it the way I wanted to. And that's ultimately what led me to wholesaling. Is it allowed me to generate cash. It felt more scalable, more applicable to the average deal rather than creative is something I've learned. You can't force it. It just has to kind of happen naturally. So, I have not been able to make a complete business out of it, but the wholesaling was very scalable. So that's what kind of led me there.
Awesome. And what year did you get started? So when did you graduate? When did you get into actually doing your first deal?
Yeah. First deal was 2021. So just about 5 years ago-ish now.
Dude, crazy.
Yeah. But I started really learning throughout 2020.
Okay. Awesome, dude.
Yeah.
And what will you guys do deal wise, or what did you do deal wise last year, just to give people some kind of context here on with a mix of everything from the wholesales, the flips, the long-term rentals, we'll kind of leave the property management and private lending on the side for now, but.
Yeah. So we're primarily a fix and flip company. So a lot of what we did last year was fix and flip, nothing super creative on those always. I think our favorite project from last year was we did a small, I guess it was creative in a way. We took 2 duplexes that were side-by-side duplexes that were also side-by-side, and we split them all up, turned them into zero lot line residential homes. And so not creative in the structuring on the front end, but creative in how we did the exit. So really we're able to help the community there, maximize value, actually produce a product that was cheaper to own than it was to rent.
Wow.
And we proved that because one of our tenants actually bought it from us on his unit, and his monthly payment went down. So
that's awesome, dude.
That was something we were up to last year. Besides that, just some standard single family flips, handful of wholesales. We're doing a lot less of that these days. I'd say it's maybe like 10 to 20% of our deal volume. You know, we're usually doing 1 or 2 deals a month, so not like crazy high volume, but we are typically doing more what we call like moderate level flips. So they're pretty involved. You know, we're usually touching everything in those projects, so they're not like super quick necessarily.
Sure, that's awesome. So deal volume wise last year, what you guys did, rough numbers? What would you say?
Rough numbers, I would have to go back and look. It was actually a down year. I think we did maybe a dozen or a little more than a dozen deals last year. Yeah.
Cool. That's awesome, dude. But that's cool. Like, I mean, look at what you've done now. Now you've kind of built like a little spokes in different areas within the real estate business to, you know, if flips are down, you got this going on. If that's happening, you got this going on, right? You've got a little bit of protection from just certain segments, maybe.
Yep. We try to be multifaceted for that reason. I think last year, another reason our volume was down, partially market related, but also like the projects we selected. We had multiple projects that were hundreds of thousands of dollars in renovation.
Wow.
So there was 2 alone that broke $250,000 in rehab. Actually, 3 that broke $250,000. So we had $1 million in rehab across just 3 projects.
Oh my goodness.
You know, that slows you down a little bit.
Dang, dude. What was that? And how long did those projects take besides just the rehab cost? Like, what was the time to from start to finish on those things?
So it varied. So one was those 4 units. That was one of them. That one went really well, really quickly. Since it was like kind of a bunch of mini rehabs within a bigger project. It's very scalable, repeatable, and those ones flew, relatively speaking. We had a 3,600 square foot house we renovated that closes on Friday. And that one, we started out, I remember like $250,000 in rehab budget, but we ended up with like 340-ish thousand in rehab on that one. So that one took an entire calendar year. Actually, it'll be 13 months close to close when it closes out on Friday.
Holy cow, bro.
And the third one's still going. We haven't sold it yet. Like we finished the project, we haven't been able to sell it. So that one was a tough one.
Oh my goodness.
See the outcome.
Wow. Let's go back to the second one there that you're talking about that's closing this Friday.
Yeah.
So by the time this podcast hits out, you're going to have money back in the bank here. So what are the numbers on this thing? Are you guys going to be able to be profitable on this deal?
We are. And that's by, you know, the grace of God or whatever you want to call it. Definitely got a little lucky. Usually when your budget runs 100,000 plus over what you originally expected, you wouldn't make money usually.
Right.
Well, we tend to be pretty conservative on our underwriting. And so it's in a very desirable location, Waukesha County near Meriden. It's right by the golf course, a block off the lake. It's got some unique attributes to this property. It has 2 kitchens instead of 1. It's basically like almost like a duplex, but it's not. Like the lower level has 2 beds, bath, kitchen, laundry. The upper level, 4 beds, 2.5 baths, kitchen. It's a big property and it's very unique. And so we don't have like standardized rules for adjusting for kitchens, and we like to use real data so we don't try to extrapolate too far, and no one was really flipping on this, like our level in this area.
Sure.
So our comp suggested like we were going to sell for like 750. But we're selling for 900,000. So so like we didn't. Yeah, exactly. And so it's all going to work out. Not going to be a home run. We're kind of estimating we probably make about 60 when all is said and done. The investors on the deal will do really well because we held it longer than we expected and needed more rehab funds than expected. So the investors, the private lenders will do really well, probably better than us. But everyone, I think, is going to come out in a good place. The buyers are super excited. Got to get to know them throughout the process. You know, doing punch lists. So overall, really good deal. Awesome portfolio builder. Definitely one that was a little stressful along the way.
Yeah. A lot of capital being laid out there, just sitting there, right? Like you said,
Yep.
man, that's great. So let's go back. You talked about private lenders there, Joe. Like, is that the main funding source you guys use for these flips, or how are you guys financing these projects, especially with these bigger rehab budgets that you're working with?
Yeah. Our preferred financing is like, in my opinion, super boring, but it seems to be the most efficient. We grab 80% of our acquisitions funds from the bank. We have a really great bank that we can work with quickly, no appraisal, quick close. And then we grab the rest, the 20% down, and the rehab funds and holding cost, all of that from a private investor. Sometimes we stack them if needed, depends on how much we need, how much they have, all that good stuff.
Sure.
But ideally, and pretty much always, we end up 100% funded using that model.
Sweet.
And it keeps the cost of capital relatively stable and low because the bank kind of blends the rate down on the front end.
Right.
And then the private invest, so you get a blended rate maybe closer to 9 or 10% versus, if you were just purely going like the hard money route, you might be looking more like 12 plus, depends what market you're in.
Right. Yeah, you're 15%, usually 12 points or 3 points. Typically 12% is kind of the going rate in Wisconsin. Right, yeah. So you're at least 15% if you go the full length of it, fully.
Exactly. Yeah.
Yeah. Wow. That's awesome. So the private lender piece, this is an interesting thing because one of the things I preach to investors in our area when they're asking is like, I'm a big fan of having multiple buckets of money, right? So you've got your commercial bank you talked about, you've got hard money lenders. If you ever needed them, you've got them, right? You can use them. Try not to.
We do. We try not to, but we do. Yeah. We definitely do. Yeah.
They're there. They serve a great purpose. They're awesome.
They're awesome
for what they're good for. And then you've got the private lender piece. There's HELOCs that, if you've got a home with equity, you can tap into that, assuming that you know what you're doing. I don't recommend it if you don't know what you're doing, but if you know what you're doing. So there's different ways to finance these deals, but private lenders is one of the secret sauces, I think, to people 100%. Who want to scale and grow and that sort of thing. What are some of the things you found with private lenders, like raising private capital? What are some of the things that have worked really well for you? Are there any kind of hacks you've kind of tapped into that you're like, hey, this is how we found them. This is what we say to them. This is how we do it. Like anything that you can provide for people out here listening to this podcast on the private lender piece of things.
Yeah, I think I have more to say on like how we've retained them and built them up. So my partner Kent's actually just naturally really good at raising capital. It's less my strength. I'm not one that loves talking about money to somebody new. I've gotten a lot better at it. But I would say what keeps people coming back to us and then having more capital and, just really becoming like, I don't want to say solely working with us, but pretty close to it is I think communication is key, always updating them along the way, usually having really conservative projections to them. And so when we put something out, we show like, hey, we can probably get to here. We've underwrote it down here. And despite that, you're still, going to have a loan to value at, let's say 75%. So they can see like, it's not like we're just squeezing this thing to the very edge of what's, safe or reasonable. And so they can feel really good coming into it, that it's a good deal. Yeah. And then, it's that constant communication along the way.
Nice.
There's been times where if something goes really well, goes quicker than expected, we might even give them a little bonus because like, hey, we told you we were going to have you out for 6 months and we got a wholesale opportunity, sold it in 30 days. So we'll pay you out for 3 months. We've done that, not a lot, but a few times. And so, yeah, I think it's a combination of, good upfront underwriting, really good follow through on the communication along the way, even when things aren't going well. Like with the one I mentioned, we had to get an extension on this one selling Friday, but we were communicating that long before, like we could see it, the extension coming months in advance when we were getting hung up in inspection. So that we were keeping them updated on that months and months before they needed it. And then, when we do pay off someone super early, we try to still make it worth their while that they came into the deal.
That's a really good nugget on that piece about the little bonus thing. Like we don't do a ton of flips. Obviously, we mostly wholesale, but we've done flips. We've raised private money. We've done all this sort of thing. And I had a similar situation. I had one we just kind of turned and burned it within 30 days or 45 days. And we were paying, I think, 10% interest on it to the private investor. And when we added up the interest, I was like, I won't even get out of bed for this amount of money I'm about to pay this person.
Yeah.
Like, I'm just going to pay him another, $1,500 on top of the $500 or whatever it was supposed to be, just because I want him to come back and do it again. Right. And I
Yep.
want to just incentivize them. And then I showed them their return as well. And I said, hey, look at what your actual return on this money is now in this 30-day period. And they were like, whoa, you show them that big
Yeah.
giant percentage now when you add
Yeah.
that little
Blow it out
bonus
over
in.
the year to show what the annualized
Yeah,
rate.
they're like, oh my God, what, you got any other deals? I'm like, hey, not all of them are going to be like this. Okay. Just take it
Uh-huh.
easy. But, yeah, no,
Yeah.
that's great. That's
Yeah.
good.
It is always a balance, right? Between not taking care of the investor, the private lender, and like not going too crazy to where now they only want like the cream of the crop, have the right expectation for the next one.
Expectations right there. You
Yeah.
just said that word that was coming to my brain for sure. The communication piece too, I think for the audience out there listening to this, communicating, Joe talked about communicate through the process, but especially when things aren't going right, try to get out in front of that stuff. I know with the guys at Good Faith Funding, you know those guys as well.
Dude, they're
I know
awesome. Yeah.
yeah, that's one of the things that I hear them talk a lot about is like, hey, if something's not going right, reach out to us as soon as possible, because they've been in the industry for a long time. They might have people they can connect you to. They might give you some advice, some tips, some other things that can get it out of there before you default on that loan. Now you're calling them a month before you're going to default. And they're like, bro, we haven't heard from you in 5 months. What do you mean
Yep.
this thing's not going right? And so it's just that constant, it's a partnership with your lenders, right? Like you have to
It
treat it
really
that way.
is. It
Right.
really is. Like they're your lifeline at the end of the day.
Mm-hmm.
If you're a flipper, a buy and hold investor, whatever it is, and you're using private capital or hard money or even the banks, everyone, like they're your lifeline. And so, yeah, we really do try to take care of them, give them everything that they need, and communicate.
For sure. Yeah, for sure. So important. And that's not just in lenders, that's everybody, right? The ones that separate the people we like to work with, like think about a contractor, right? Your best contractors are the ones that communicate, not the one that you show up and they're not there. And you're like, where are you guys? Like, oh, I had this other project I had to go do. And you're like, dude, you told me you're going to be here. You're not here, right? It's like it's just constant communication, man, all the way across the board. Such a hack right there. Talk about protecting your private lenders, because I think this is one of the things. If you're brand new, most people out there, the thing that holds them back is they're not confident in protecting that person's capital, right? They don't have the belief yet that they can get this person their capital back. Some people, though, might just be out there running and gunning, going 1,000 miles an hour and not know how to protect their private investors. Talk about how you guys, you talked a little bit about the underwriting piece. What are some other things, the instruments you use, the insurance, like whatever else, to make sure that your private lenders are safe?
Yeah. I mean, we do obviously all the what I would consider basic standard things that everyone should be doing, right? They're going to be insured on the hazard insurance. They're going to have a mortgage recorded. They're going to have a promissory note, personal guarantee. Sometimes we get them a lender's policy. Not always. We actually used to always 100% get lender policies for all loans, even the junior. Now we kind of leave that as an option for them, because it was actually our private lenders that came back to us and like, if you're getting one for the first, I actually don't need one in second. Like I feel good knowing that you've already insured the first, it's going through the same day. And so that was like kind of an interesting one. I'm not necessarily giving that as advice, but it is something that I just learned over the years. Like I was spending money on this policy that, at least for some of our lenders there, like it's actually fine. Like don't do it.
Really?
So we normally do it. That's our standard. But we've actually recently had, in the last like 16 months, some of our private investors actually say, hey, you can save the money. It's fine. So we used to do all four. We still do all four most of the time, except for a few exceptions where they've been the one to say not to. Other than that, I think the biggest thing that we do, and I hope everyone does this, but maybe not, is we actually do really good accounting where every project has its own project account. And so we don't commingle funds. And I think especially as you're starting to scale, that's something that's probably really difficult. I know it wasn't easy for us at first. You go from an operating account to we have to have 20 plus bank accounts, maybe more, because we have so many projects going and we don't commingle funds. So that's, I think, the biggest thing we do to protect our investors is like they know that if they're giving us a huge sum of capital, it's sitting there and it's only going into this project and we can track every penny. So,
dude, that is such a good one.
That not everyone's doing that they should be.
That is a really good one, because I know for us when we flip, like we're not really raising private money. It's either my own funds or HELOCs that I have on investment properties or whatever that we use for funding it right now. But for me, the accounting side of it's a nightmare. because I'm like, I
Yeah.
put it into our operating account. Like, oh, like right now, I literally just told my assistant, like, hey, we have this bill for like 15 grand for a well and septic or a septic or whatever. I was like, hey, can you send a check out? It's going to come out of my operating account. And my bookkeepers will track it and it'll be in and classed in there and stuff. But cash flow
Mhm.
wise, even it messes up my cash flow for the actual operations of our normal business. Or if I just had that separated, I only have that amount of money to spend, and that's the money that's going towards this project. I love that idea. That's so good. It's a little more tedious on the front end, it sounds like, but it keeps it.
Yeah, it's tedious to get it all set up, perhaps.
Mm-hmm,
I would say that's where it's tedious, but it actually makes the accounting easier
mm-hmm,
because we have a full-time bookkeeper and he knows if it's being spent from that account. He doesn't have to question like what project it's for. He
for
already
sure.
knows. I mean, if he
Easy.
sees something that looks like it could be an error, obviously he's still going to audit it. It's not like he's able to just blindly categorize things, but
Sure.
99.99% of the time, he knows if it's in that account, it's correct.
That's awesome. So basically, the way you guys are doing this, just to recap, you're setting up 20 or so different accounts, and then you're picking an account like, okay, this project on Friday's off the books. We close out that whole thing. Now that account is freed back up to use for another project. Is that how you guys are doing it?
Exactly. Yep. It
Okay.
closes out like this one for Beaver Lake was the property. It'll close out on Friday and it'll roll right into our next one here in Middleton. So
Nice.
we're, sometimes it's a little, bit of a game of Tetris, like kind of time it out, but it works really well.
Yeah, and I would say most banks are fine opening up different accounts if you need them, right? They're not going to put up a fight with you about how
No,
many
we
accounts you
we
need.
use Summit. They've been great. We can have as many accounts as we want. We were with Chase. I remember we switched mostly because there was like a minimum we had to keep in the account, and it got to the point where it was
Mm,
like actually starting to be a decent amount of capital tied up. If let's just say I think it was like a 2K minimum, across 20 accounts, it's like, well, now you've just locked up $40,000 for the sake of keeping accounts open. So
yeah,
that's like one of those things we had to learn early on and just pivot to somewhere where they didn't have that same requirement.
yeah.
And so it's just a little thing. I wouldn't let it stop anyone from doing it, but just to be mindful of like what's the policy at the bank about minimums.
Yeah, no, that's really good because like even if I know like my bank account, I think if it's a business account, I have to have $1,000 in there. Otherwise, they charge me like $10 a month if I don't. And now you spread that
Mhm.
out again. $10 doesn't seem like much over 20 accounts, but every month that adds up, right?
It
There
does.
goes
Yeah,
$200 a month down the tubes just because you didn't have a minimum account in there, which
exactly.
is
Yeah.
interesting. Talk about, let's go to the creative deal structuring thing because this is something you've done a lot of. It sounds like over your career. You mentioned Pace Morby. So those of you guys that don't know Pace, he's kind of like the main influencer out there as it relates to creative financing and those sort of things. But talk about this, some examples of creative financing, different types, when you use it, how it's been helpful for you, and we'll kind of dive into the creative deal structuring piece of your experience here, Joe.
Yeah, I mean, it's been helpful for different reasons at different times. Like early on, it was helpful. It's what got me my first deal.
Okay.
And so my very, very first deal was actually seller finance from another investor who had gotten seller financing from the seller. And then I turned around and seller financed it on the disposition versus via lease option. So my very first deal was like a seller finance mortgage wrap to lease option, right? And
Wow.
so just kind
And
of
some
dove right
people's
in.
brains just went, they're like, what the heck does that even mean? I don't even know what he's
Yeah.
talking about.
Yeah, and so basically what that means is the investor got seller financing from the owner of the property, bought it on terms. He then took, and I don't know if they're going to be able to see this, but they wrapped that note. So basically he gave me a note that said my paying his note to him included the payment that he owed to the seller.
So he's
So
making a
that's,
little spread on the note he's charging you. He's taking the difference, paying his original guy. So he's still in the deal in some aspects with the money
yep,
movement. Okay.
yep, he's in the middle. And so, yeah, that's called a wrap. And so he wrapped it to me. And then I had it on terms, and it wasn't like a home run deal. Um, and that was okay because I was able to put it out on a lease option, do a rent to own. So basically, in that structure, I had two instruments: a lease, which is just your standard lease, a month to month is what I like to use, and then I had the option agreement saying that they could purchase it from me at any point for the next, I believe it was 2 years, with the ability to extend up to a year twice. So really, it was a
Okay.
4-year option. And then by doing that, I was able to collect money down from the tenant buyer, which helped kind of offset my cash in the deal. And then B, it also just kind of let me know they were going to take really good care of the property, you know.
Yeah, for sure.
And so it reduced my cash in the deal, allowed me to cash flow and basically take what was otherwise probably just a base hit, almost paid retail sort of deal, and actually made it cash flow really well. I think it started out, a couple $100 a month. I still have that property. It's probably making like 400 a month if I had to guess now. So they ended up not fulfilling their option, unfortunately, on that one.
Okay.
Which is never the goal with those.
Right.
We always want to see them succeed. Most of them do.
Yeah.
Unfortunately, that one, they had a life change. And so, the family kind of parted ways, and the one that decided to stay didn't want to take on the ownership of the home himself. So he's just like, hey, I'm really sorry. I don't want to follow through anymore. I do want to still keep renting it though. So it all worked out relatively okay for everybody in the end. It wasn't our intended outcome, but we kept pushing forward nonetheless.
Awesome.
And so early on, it was just like a necessity to get the deals done. And then I guess what it's evolved to now is we use it more in the context of a seller who's the cash offers, it's just not going to work for them. So super recent example of that, had a seller here in Madison, referral deal, cash offer, I believe it was like 180 grand. We thought we could list it for him as well. We figured if the market pushed because it was a desirable area, he might get into like the low twos, 220 we were like hopeful for, but doubtful, but hopeful. And so that was kind of his operating range, was like 180 cash or, maybe 220 on the MLS. Realtor commissions come out of that, obviously. So,
sure,
it's not truly 220. But he didn't want to do all the work it took to get it MLS ready. It was a hoarder house, but was really stubborn, didn't want to take the cash either. And so we were able to meet in the middle, put together a joint venture, I guess you could call it, structure, using, in this case, a note and mortgage. And so what we did is we figured out how much money he needed down for the property to get all of his like immediate debts taken care of and have enough to live on during the project. So we got him that money down, and we got that money by taking a first position loan against the property from a bank. And then that also ended up becoming our rehab money. And then he took a second position for what was left of 200,000. So it was roughly 60 grand down, taking a second for 140. And then we kind of put him up in a hotel. He's actually there currently. This property hasn't been sold yet. And so we've been paying for a hotel to keep him housed, got him set up with a cell phone and all the things needed in the meantime. And essentially then what we're able to do is get him 10% more money by paying him a majority of it on the backside, but taking care of all of his needs in the meantime. And it really solved his biggest problem, which was he needed more money, but wasn't able and willing to do the work it took to get it MLS ready.
I love that, dude. That's the beauty of what Joe's talking about. Like, you can take people who otherwise, if you only have one option in your tool belt, you're going to miss out on some ways to solve people's problems, really, and really serve your clients at the end of the day. And we've done several of these. We actually have one right now with a portfolio that my commercial guy's working on. I think it's 7 units. It's a probate situation. One sister wants cash. The other one doesn't care and wants, is fine taking payments over time. So we propose like, hey, let's get your sister the cash, and then you carry the rest of it as seller financing for 5 years. We'll get a commercial loan from our commercial bank for the first amount. They'll carry it, and we're also going to increase that price a little bit to get a credit back to cover all the rehab on these things. So then we'll have no money into this deal. It'll still be positive cash flow. It'll basically be an infinite return on our cash, and there we go. Yeah,
I love it.
So yeah.
No, it's great when you can do that. You can bridge the gap, make everybody happy, meet the needs of the deal, of the people involved, and hopefully still have it be profitable.
That's always the goal, right? Yeah, that's the hope, right? Yeah, it's fun to put them together, but if you're not going to make money on it, what are we doing here, right?
Yeah, exactly.
We did another one with Joe's talking about. This is back in the height of the Airbnb days, right? When Airbnbs were the hot thing. But up where I live in Door County, we had a gentleman, similar situation. Like, he had it listed on MLS. It was a really nice house for like $700,000. Took it off the market after a few weeks. And I said, why did you take this thing off the market? And he's like, I don't want to have to get rid of all this furniture and stuff. And I was like,
wow.
Okay. well, what if I could get, just buy it as is? And I was trying to get a cash deal from him. He wanted more money. I wasn't comfortable coming up on the price cash wise.
Yeah.
And I said, well, we just sat and talked about it. And I just said, well, what do you need the cash for? Like, what do you want the money for? He said, well, I really don't need the money out of this. He's like, I just want that mortgage taken care of and I was like, well, what do you owe on the mortgage? He's like 230. I was like, okay, if I can take care of the mortgage, are you cool just, collecting a check every month on the rest of it? And he's like, what does that mean? I'm like, well, right now he was self-managing the Airbnb, right? I said, right now you got to come over here. You got to clean this thing every time somebody checks out. You got to deal with, the people inquiring and all this other stuff. If none of that, you just get a check every single month from me in your mailbox. How would that sound? He's like, oh, that'd be awesome. Yeah, that'd be great. I'm like, perfect. So we got a first position mortgage. They actually the bank also covered our furniture and rehab for us to outfit it. And then he took a second position for the rest of it. And he still, to this day, gets $1,800 every month. And he's tickled pink, and he's like one of our biggest fans. He's like, this is great. I love this check every month. This is amazing. I don't have to do anything for it.
Yeah. I love how you set it up too. It's not like, oh, do you want to give me a loan or put together a mortgage? You're just like, how would it be to collect some payments every month? Like that is like such the perfect way to explain it. Cause I think the number one thing that I messed up early on is I would get so deep into like the lingo while I was trying to pitch a creative deal that I would lose them. Even though I actually had the solution that was better for them, I would lose them before I could get there because the confused mind says no. But as soon as I unlocked, like, keep it simple and just explain like the benefits and how the cash is gonna flow to them and when, that's all they actually care about.
Exactly. They don't care.
All the tools you're using to protect them, like that can come later, but it's going to blow up the deal in there.
If you start talking about wraps with them, they're gone. They're like, what is this guy talking about? Like, I'm not hungry. I don't need a wrap. What do you mean? You're losing there. So no, that's a really good tip. So if you guys are out there pitching this stuff, the other thing I would say, Joe, like legally speaking, how did you make sure you were doing all this stuff the right way? I mean, when you got this, because this is, you're potentially messing with people's credit here. And it's a pretty big liability or trust that you have to have with that. It's a relationship you're entering into for a long period of time with that seller and these things. So what are some of the things you have used to help ensure that what you're doing is on the up and up and you're doing it the right way?
Yeah, I think early on, the biggest thing was education. Like I studied this stuff a lot before I started implementing it. I mentioned I was lucky to connect with some mentors early on that were already doing it, legally and, the right way. And so I'm never one to just think I can do something without advice. I try to be humble and know that I don't know what I don't know. Yeah. And so a lot of reaching out to other investors, networking, even doing some joint venture stuff to learn through partnership was huge. Not necessarily always just on creative deals, even just like across the board. That's how I've learned most of my things, is finding someone that knows how to do it the right way, giving them a piece of the deal to learn with them to make sure I take care of the seller properly. And then more recently, we do have an attorney, Sean St. Clair. He actually does some stuff for Pace Morby, I believe. Don't quote me on that. And he's just like a genius when it comes to creative deal structure and knowing how to do it legally. So whenever we're getting into a structure now that, we're like, hey, we haven't come across this. No one in our network's done it. There's no one to partner with. Like, I know I can call up Sean, spend 30 minutes or whatever it takes on a phone call, send over what we're thinking, and he'll put it together and make sure it's legal.
Yeah. So I think that was the key I was hoping you would talk about, is get that attorney involved in this whole thing. Yeah. And Sean was on the podcast, guys. If you go back, it's early on, I want to say within the first 20 episodes, somewhere in there, you can go back in the archives and find the episode we had Sean on here talking about creative deal structure and, all the stuff you got to do to protect the sellers and disclosures. And there's a lot of things you got to make sure you're doing the proper way. Because if you don't do it the right way and you're out there just winging things, you can really mess up somebody's life doing it the wrong way. So always make sure you consult with an attorney. And Sean's the best in the business, I think, as it comes to creative
100%
stuff. We're very lucky that he has a Wisconsin license. So he's licensed in Wisconsin and Arizona. Yep. So we're very lucky that we have a guy like that who's done thousands of these, structures right in our backyard here in Wisconsin. We can tap into him for those types of things. So that's fantastic. I love it. What is the you mentioned moving away from wholesale more into flip. What was the catalyst for that decision for you guys, Joe, in your business?
Yeah. It really came from, I guess, for me, finding fulfillment from working with other people, joint venturing. I had done some one-off joint ventures. I had done some more consistent joint venturing with another wholesaler, even when I was wholesaling. But then I met my current business partner, Kent, and he was a licensed general contractor. And when it started out, I knew I wanted to do some actual projects and not just always wholesale, but I also knew that I didn't know how to do a lot of that stuff. And honestly, it wasn't really my strength. And so Kent and I partnered. It went really, really well. And what we found was, we worked as such a good team that it just made sense, to lean into what we were good at together, which is flipping. And so it was kind of a natural evolution. I still do love wholesaling. But it is also really satisfying to see the property go from, a diamond in the rough to this really cool thing that a family can enjoy, and knowing that we get to shape that. And I don't know, I do enjoy the flipping process when I don't have to be the only one doing it all. Like, I don't think I'd enjoy it by myself, but in a team environment that we've created, it feels like the way to employ and incorporate the most people into our system, and just have it kind of be the environment that feels right.
Awesome, dude. That's so great. Joe, what Joe just talked about there, guys, there's a book that I love called Who Not How. And it's, what Joe found was he's a who for Kent, and Kent's a who for him. And those two are, it sounds like you guys are, your strengths, and you're both kind of staying in that lane, and you built a business model around what you guys are both really good at. And those two things complement each other. And then you found some other who's to bring in there to help supplement the other needs that you guys have, which is really, really cool to see.
Yep. I don't think I'd be flipping if I was solo. I can tell you that. I can tell you that. Yeah.
One of the other episodes, it's either going to be after you or before you. It's going to be around the same time. But we were just talking about this on there's like flipping's a different animal than what people think, right? Like, I think people get into real estate and they say, I'm going to do real estate, and then they go like do some rentals. They think rentals are the same thing as flips, and they're two completely different businesses. Right. Have you experienced that same thing on your side of things? Because you guys are dabble in all of it too. So.
Yeah, it's all very, very different. I would say the buy and hold rentals for us are more similar to the flips in some ways than maybe it would be for other people, just because we like doing heavy value add even for our rentals. So we still follow a very similar process up until the point at which it doesn't get sold, it becomes a rental. So in that sense, that's very similar. But when we were doing all the management, or when I was doing all the management, felt like a very different process. Now that we have a management company and someone that's specialized in that, it feels very similar to me now. But in the early stages, it's very different, going out and finding those tenants, dealing with their complaints, keeping them happy, making sure rent's paid. That in itself is a full-time job, which is for sure why we had to find a full-time person just for that.
Yes, exactly.
I know you have a great property manager.
Yeah, you guys have two different businesses really though. Like, you have the property management business, which is doing the flips. That's part of your business, is built into there. And then you have the flipping company, but those are really two separate specialties, right? Like, they just happen to incorporate. You just have the construction piece, which is a huge advantage for you guys in the business. But for most people out there that are just starting out or trying to get a few things, there's really two different animals that, you gotta focus on. That's why I love the property management company I referred you over to, because they have the construction in-house. If you're a real estate investor and you're in a market that they serve, it's very easy to scale your rentals really quickly, because you can literally just buy, hand them the keys, and get out of the way, right?
Yeah, that's an incredible model. But yeah, I totally agree with you. If you're starting out, you definitely need to just pick something, get really good at it. As long as you like it, stick with it. And if you don't like it, then maybe consider a pivot, because you do have to enjoy it. I guess is maybe something I left out with wholesale for me personally. I didn't find that I loved the process as much as doing acquisitions for a flipping business. And so even though the process isn't that different, I just found I was getting a lot more fulfillment when doing it as part of a flipping business than I personally was when doing it for wholesale. And I think it's just because I don't love dispositions. And so that's a very important piece, as you well know, of the wholesale process. And if you don't love that piece, then wholesale can be really exhausting over a long term.
Yeah, I think I get hit up pretty often by people who want to get into wholesaling, and when I really get to the root of it, it's because they think it's the easiest barrier to entry to get started in, and they think it's the easiest to do. And really, it's the same thing. You have two different businesses. You have an acquisitions business and you have a dispositions business. And those are two different businesses, two different customers, two different needs, two different desires, two different processes you got to run. It's really, you have two different businesses, which is why we have Wisconsin Discount Properties as one brand. It's still in the same company. We have I/BUY, which is the acquisitions team. And those two things are two very separate, different messages, people, daily activities. It's all very different. And so you can wholesale it, casually just by going to networking events and knowing other people and stuff like that. But to really truly build like a significant business, it's two separate lanes that you got to have operating at the same time. Two businesses really you're operating at the same time.
100%. Yep. And I found for me, it was like, I loved the acquisitions process and I didn't love the dispositions process. So it was either do what you guys did and built out that team, or it's like, if we can be our own buyer, do the projects, then I don't have to deal with that disposition process. So that, thinking about it a little bit more, is probably the biggest reason that we leaned into flipping, for at least myself personally.
That's awesome. Well, I think something Joe just talked about here too, guys, is he's doing something that fulfills him, right? Like we all get to choose what we do every day, right? We can choose to keep doing what we're doing, work where we work, build a business somewhere else. But if you don't enjoy what you're doing, why? Life is pretty short, right? So find something you can dabble, right? We dabbled in everything when we started. Like my first deal I ever did, it was a rent to own on the house that we bought. We lived there for 6 months and I hated living there. And I was like, I can't sell it now because I'm going to lose my butt after I pay realtor fees. And I'd spent like 10 grand on stuff. I didn't have hardly any money back then. And so we did a lease option to keep the realtor out of it. And then it worked out, right? We actually ended up making a pretty good amount of money on that. I did a joint venture with another guy on like a creative finance deal because I didn't know how to do those. So like you said, partnered with that guy. I did some flipping. We had some burr deals that we did. We wholesaled a couple deals. I call it the buffet of real estate.
Sounds like
tried it all out, right? And then I found I got a lot of fulfillment from the wholesale. Like I loved finding a property and getting a good deal on it and then helping that person. They got a lot of relief and satisfaction from what I was providing. And then I had this investor over here who was also excited because now they're going to make some money and change their future. And I was like, I love this connection piece of it. It was really fulfilling for me. So we, my wife and I just doubled down on that piece of it. But just find what you like to do. It's okay to test stuff out, but find what you like to do and double down on it.
100%. That's really good advice.
I love it. Well, that's your advice. I'm just reiterating it. It was your experience. Yeah. I'm just summarizing it. Yeah.
Yeah.
Well, Joe, man, this has been awesome, dude. So we always end with a fun question. And part of why we do this is we have people outside of Wisconsin that have, they're looking for a place to put capital or they're looking for a place to start investing in. They're in California, let's say, or Colorado or some kind of cost prohibitive market. They find Wisconsin, they want to know about it, but they don't know anything else about it besides just looking at some spreadsheets and numbers. So we like to tell them a little bit about the state and they listen to this podcast. So for you, what is your favorite Wisconsin tradition or place to visit here in our great state?
I think my favorite place to visit is a recent one. It's the Apostle Islands.
Oh, way up there.
Yeah. So I had never been there until a couple of years ago. I got into sailing and we decided to take the sailboat up a few years ago. Okay. And it's like another world up there, man. It's just totally different. It's the only place probably in the entire US that there's like no light pollution. So if you want to see the Northern Lights, that's the place to go. You can camp on the islands if you're into that sort of thing. It's definitely an outdoorsy place. There's not a lot of population or anything touristy about it, but if you're into the outdoors and want to just get as far away from people as possible, the Apostle Islands is a really cool destination.
Dude, that's a good one. I don't think anybody said the Apostle Islands yet, but I went up there, I don't know when that was, maybe 5 years ago or something like that. And first time I'd ever been there. And you're right. You feel like you're in like, what is the, I'm trying to think of the movie Avatar or something. You're like this whole different world of like, this is crazy.
Yeah, the water's so clear. Everything about it's just really unique and special.
Yeah, for sure. That is awesome. Well, Joe, if anybody wants to connect with you, brother, what's the best way for them to reach out if they want to, they got a deal that they want a JV or they just want to connect with you in some other way to talk about it? You guys are also doing some private lending now coming up or some hard money lending stuff. You've got management down there that you guys have built and you're growing that. Like, what are some ways if anybody's interested in connecting with you that they can reach out to you, man?
Yeah, they can go online to rezenhub.com if they're trying to connect with us for like our fix and flip business, wholesale business. For property management, we have Rezen.com. Otherwise, if they just want to connect with me personally, they can shoot me a DM. I'm on Instagram at @MillerFlipped. So any of those places are great to connect, and I look forward to having a conversation.
Awesome, bro. Well, I appreciate you being on, man. This has been great, guys. If you got some value out of this, we always say this, please share this episode with your network. It helps us a ton. And it helps you a ton too, because people will see, hey, you're doing real estate. They may want to bring you some money. They may want to bring you some deals. They see that you're into this stuff. So it helps you build your brand as well. So we appreciate those. If you're in the Madison area and you're interested in getting into real estate acquisitions, we are hiring right now as well. We are looking for 2 acquisitions reps to join our team. So basically what you do, you go out, you meet with property owners and you try to solve their problems. And then we take those and we connect with guys like Joe who can take them and make them beautiful. It's kind of the model here, but we need some people on the front end. Yeah, we need some people on the front end. We're not looking for people looking for a stepping stone or just for an internship and they're going to jump ship and go. We need people who are going to be with us for the long term. You like being part of a team. You like, as Joe said, you want to be the who on the acquisition side. We're looking for you. So if you're interested in that, you can reach out to me, Corey, Corey, at ibuywi.com. And would love to chat with you a little bit more and see if you're a fit for the team. Other than that, guys, we appreciate you listening every single week. We will see you guys on the next episode.